Joining us here at Post 9 this morning, Goldman Sachs Chief U.S. Equity Strategist David Kostin is with us. DK, welcome back.
Nice to see you. Very good to see you.
You've been asked a lot about your target the last few days, and the first thing you generally point to is earnings growth, right? As opposed to a multiple expansion.
So in the last couple of years, the PE multiple for the S&P 500, Carl, has gone from 17 to about 22. So huge multiple expansion. We think about the market going forward, it's mostly going to be earnings growth in terms of our analysis. And so earnings growth, we're looking around 11% earnings growth for 2025, 7% earnings growth in 2026. Now, that's because most of the companies trade around fair value. Not necessarily all companies, but in aggregate, pretty much close to fair value at this level, around 21.5 times multiple. So the earnings growth, and the point that's worth emphasizing is that the relative earnings growth between the Mag 7 and the rest of the market is narrowing dramatically. To put some numbers on that, you've got the Mag 7 have earnings expectations for this year of around 33%. That's going to be relative to the rest of the market around 3%. So in aggregate, you'll get around 8% for this year. Next year, that's going to narrow to around sort of 5 to 6 percentage points. And that is the reason why the expectation we have is that the Mag 7 will outperform, but by a much narrower amount. And again, put some numbers around that. 2 years ago, it was 63 percentage points of excess return. Right. This year, it's around 22 percentage points. Next year, probably 4.
And that growth slowing is greater than the rest of them catching up, in other words.
Correct. Well, it's a little bit on both sides.
It is.
The diminution in the growth rate for the Mag 7 and a little bit increase in the growth rate for the rest of the market. And that, in aggregate, we'll be around 11% for next year.
And that's why you said that my kids should be in equal-weighted S&P index funds.
And that's the argument. If I look out longer term, the idea of the equal-weighted index is likely to do better than a cap-weighted index over the next decade. And the thought process behind that is that the concentration area is so high right now, and historically speaking, you have a concentration that's likely to come lower. It can come lower for different reasons. You could have the largest stocks in the market come a little bit reduction in their PE multiple, or you can have the broadening of the market, and I think that's more likely to happen than not. So what are the portfolio managers asking right now? They're basically asking three strategies. One is the Mag 7, how to think about that. It's been the number one determinant of whether a mutual fund outperforms or underperforms their positioning in those Mag 7. The second, core to David's heart, is the M&A.
Yeah.
And the strategy around M&A. Our forecast is you've got 25% increase in M&A activity in the coming year, like 750 transactions over $100 million. That's our forecast and our model. And so a portfolio of companies that are higher probability than normal or than the typical stock, likely to outperform. That's sort of one strategy, a lot of discussions with...
And you guys have a basket for that, amazingly enough, isn't it?
David. Yes,
you guys at Goldman are so creative.
Okay, well,
62 potential U.S. M&A candidates.
Correct. Those are companies.
It's a very long ticker, so I won't say it.
Well,
but,
the idea of those companies where the individual analysts at Goldman assign a 30 to 50% probability of a merger transaction, or between 15 and 30 percentage points. So sort of two different categories. That's one big area of focus. And the second is an area thinking about the expectation that small business optimism is going to lead to more spending and activity on the part of small and medium-sized businesses. So if you're a company whose customers, whose clients are small and mid-sized businesses, they're likely to benefit. That's what we saw, a huge increase in the NFIB optimism index at the beginning of the first Trump administration. That is the argument behind companies whose more than 50% of their revenues are coming from companies in small and mid-sized areas. Those are the three areas that fund managers are focusing on with us right now.